Hey everyone, welcome back to Corporate Decoder. Today we're diving into something interesting. Imagine a company trying to buy another, but first they need to ask their friends for money. Sounds like a sitcom, right? Well, it's QXO planning to pull this off, and what could go wrong? QXO Inc. filed a report called an 8K, which is like a quick update to investors about big news. This one's dated March 17, 2025. The main story, they're selling a bunch of their stock to raise money for a big purchase. They made some purchase agreements, meaning deals to buy something with some investors, meaning people or groups that put money into businesses. QXO wants to sell these investors about 67.5 million shares of their stock. A share is like a tiny piece of ownership in the company. Scroll shares of the Camte company's common stock. Par value 0.0000001 per share scroll. Each share is being sold for $12, and so QXO is hoping to get about 830 TORX successfully buys Beacon Roofing Supply. Scroll or cash tender offer asked to acquire all outstanding shares of Beacon Roofing Supply. Scroll TQXO is trying to buy all of Beacon Roofing Supply, another company, by offering to pay cash for all of Beacon's shares. This is called a tender offer. Think of it like QXO making a public offer to buy everyone's slice of Beacon. These agreements have the usual promises and guarantees from both QXO and the investors. QXO promises that their business information is correct, and investors promise they are who they say they are and have the money. If either side lies, they could be in trouble, including owing money to the other side. It's like signing a contract where everyone swears they're telling the truth. QXO also has to register the shares they're selling, meaning they need to file paperwork with the SEC, the government agency that oversees the stock market. This paperwork, called a prospectus supplement, tells potential buyers about the stock and the company. QXO has to try to file this within 30 business days after they sell the shares, ensuring the buyers will have the ability to resell the stocks they are buying. Scroll under sections 4A's 2 of the Securities Act scrolls. This stock sale isn't being offered to the general public. It is private and is only going to specific investors. Because of this, QXO doesn't have to go through all the usual steps of registering a public stock offering. They're relying on a specific rule that allows companies to sell stock privately without all the red tape. It's like having a private sale instead of a public one. Because QXO is selling stock without registering it, it's called an unregistered sale of equity securities. This means they're selling ownership in the company, but not through a public offering. To let everyone know what's happening, QXO put out a press release to announce the private placement, meaning stock sale. It's like sending out a news bulletin to keep investors informed. The report contains forward-looking statements which are like guesses about the future. They include words like expect, intend, believe, and plan. These statements are based on what QXO thinks will happen, but they might not be accurate. There are a lot of risks that could make QXO's predictions wrong. These include everything from changes in the stock market to problems with buying other companies to losing their key people. It's like saying, we hope to get there, but a lot of things could stop us. One risk is that QXO's stock price could go up and down a lot. This can scare investors and make it harder for the company to raise money in the future. It's like riding a roller coaster, exciting but also a little scary. QXO might need to borrow more money in the future, but they might not be able to get it on good terms or at all. This could hurt their ability to grow and achieve their goals. It's like running out of gas on a long road trip. The stock sale itself could have unexpected consequences for QXO. It could change the price of their stock or affect their business in ways they don't anticipate. It's like opening Pandora's box. You don't know what's going to come out. There might not be enough buyers and sellers for QXO's stock, which would make it harder for investors to trade their shares. This could make the stock less attractive to investors. It's like trying to sell something in a town with no customers. If QXO's leaders change their minds about the company's goals, it could create uncertainty and hurt the stock price. It's like changing the destination halfway through the road trip. QXO relies heavily on its chairman and CEO, Brad Jacobs. If he were to leave, it could have a big negative impact on the company. It's like losing the star player on a sports team. Just because Brad Jacobs has been successful in the past doesn't mean he will be successful in the future. The market changes and what worked before might not work again. It's like assuming a winning baseball player will always hit home runs. QXO needs to hire and keep talented employees to succeed. If they can't do that, it could hurt their ability to compete. It's like trying to build a great company with an average team. If QXO can't complete the purchase of Beacon Roofing Supply, it could hurt their business and stock price. Buying another company is complicated, and there's always a risk that the deal will fall through. It's like planning a wedding and then having it called off. Cybersecurity is a big risk for all companies. If QXO's computer systems are hacked, they could lose important information and disrupt their business. It's like leaving the front door open to a thief. If QXO sells more stock in the future, the new investors could get special rights that hurt the existing stockholders. It's like giving the new kids on the block more say than the original residents. The demand for building products can go up and down depending on the economy, weather, and other factors. If demand falls, QXO's business could suffer. It's like selling umbrellas in the desert. Trade wars and other international conflicts could make it more expensive for QXO to buy and sell products. This could hurt their profits. It's like having to pay a toll every time you cross the street. QXO could get sued or face regulatory actions which could cost them money and damage their reputation. It's like getting a ticket for speeding. Scroll annual report on Form 10K for TAP the fiscal year ended December 31, 2000. Scroll 2004 more information about the risks QXO faces. You can read their annual report. This report provides a more complete picture of the company's business and finances. So QXO is trying to make a big move by buying Beacon Roofing Supply, but they need to raise a lot of money first. This stock sale is crucial to their plan, but there are many risks involved. The company's success depends on many things, from the overall economy to their ability to manage their business effectively. And looking at the financials, it's clear that QXO is betting big on this acquisition. The risks they've outlined are significant, but so is the potential reward if they can pull it off. However, relying heavily on one person, such as their CEO, and the uncertainty surrounding the building products industry demand are areas of concern, and in conclusion, QXO's attempt to acquire Beacon Roofing Supply is a high-stakes gamble. If everything goes according to plan, they could become a major player in the building products distribution industry. But if things go wrong, they could face serious financial trouble. Thanks for watching. If you found this analysis helpful, please like, comment, and subscribe for more deep dives into the world of corporate finance.